Samir Arora, fund manager with Helios Capital. He is ready. Let's connect with him. Samir, fantastic to have you back. We missed you on the show. Where did you disappear?
Nothing. I was taking a break. I'm still not going to be as active. I have discovered Twitter now. More interesting.
Short and
not
sweet.
really. It was just that overexposure in the last few months was getting to me.
So let me ask you a short and sweet question. In 170 words, tell me your market opinion and stocks you're bullish on.
Only 140 are allowed on Twitter, so you're allowing 170. I am not overly bullish. I have been bullish up to August end. My net was nearly 80%. And now it's back to the 60s. I think it's a good place to be in, but nothing that is going to run away in a hurry. But I don't think these markets will fall because there have been many changes in the world and in India in recent months.
Samir, a whole lot of talk around the debt ceiling, the new governor for US Fed, and of course the partial US government shutdown as well. Our markets, though, on the other hand, seem to have decoupled somewhat and shrugged off all the news coming out of the US. Does it seem like whenever the debt ceiling or tapering actually comes in, it is going to have too much of a material impact on domestic markets like India?
Well, first thing is, please note that for the last 7-8 months, India was decoupled. US was up 20% in dollar terms, they are in whatever, their terms, and we were down more than 20%. So nobody questioned at that time that we were decoupling. And my argument was that normally we had not seen, since the 90s or maybe even before that, a 40-50% relative move relative between these two countries or between generally any pair in such a short period of time. So right now, obviously, the fact that US debt ceiling, which I don't think is literally getting hit on 17th October, it is estimated to hit on 17th October because every day US government has expenses and it has revenues, so it expects that somewhere around that day they'll run out. So it's not a literal date. But obviously the assumption is that they will not let any defaults happen on either coupon payments or principal repayments, which I think are more at the end of the month. Because if those happen, then it doesn't matter where India is, and we will not be able to say that this is a US problem and not an India problem. But other problems that they have in terms of slower than expected job growth or slower than expected GDP being hit by this government shutdown, that helps India these days because it brings in hope that taper will be delayed by a few months. But secondly, obviously, a second time, the same fear does not, or the same issue does not create the same fear because you've seen it once. And broadly, we know that the taper, if it is done, it will be more like a few $1 billion a month reduction in the expansion and not really a contraction of liquidity. So this time it won't have the same fears anyway.
That's a great line, Samir, that for the second time, the same issue does not create the same fear. So what could be the new issue this time?
Well, why do we always want new issues to be negative? If you said what are the issues that could make it more positive, I would be happier to answer because in general, even though my net is more in a disciplined longer term average of 60 again, in my mind, I'm more positively biased because we have seen the worst in many things. For example, in August, there was, and I was not on channels at that time, but I was desperately wanting to say that the rupee was according to being manipulated by a few foreign brokers who deliberately raised the bogey of capital convertibility. Instead of saying that there were fears of capital convertibility which are completely unfounded, they made it look like you are saying catching that there is fire in a theater because you saw somebody smoking, and so if somebody catches you for creating stampede and death, you say, no, I was being very true. Somebody was lighting a cigarette. And that is exactly what was happening there. So those were bad times, and reversal from that in September actually is only because in August we blew everything out of proportion because maybe either some people were bearish or had a negative position or whatever. And I was delighted to note last week in Financial Times cover story what I had been saying privately, that there was manipulation in many markets which I didn't care about and currencies, but it also said including Indian rupee. So today, don't take it so much as that in September, the market has rallied a lot. In August, it went down disproportionately, both the currency and the market. And therefore, in rupee terms, it is zero for the year to date. So it's not that anything much has happened. And some of my favorite stocks, particularly the private sector banks, are down 4 to 5% in a year-to-date basis. And this is not bad considering that they've always given 20-30% per annum, and therefore they are already cheaper by about 25% from a year ago. So things are not bad, and therefore I am not deliberately going to come out and give you some negative story so that you say that we are bearish because this may happen. It's okay, it's a normal market, not running away, but we have passed through the worst.
But Samir, Infi, the big one, which is going to kickstart the earnings tomorrow, what's the expectation? Do you think IT is going to continue to outperform this quarter as well?
I think in general, because we have, as a market, recently seen a rupee of 68 or 69, and to suddenly at 61 or 62, there will always be this fear that, is it permanent? Will it go back because there is oil demand which is not there, because we have had these FCNR flows. So therefore that fear will always be there, and therefore for many months and many quarters we will always seek shelter in exporters, and tech being both a foreign exchange earner but otherwise also sort of a higher quality group, I think will continue to get a more than fair share. And this won't change even if rupee goes in to 60, let's say, or 59, because the fear will not go away so easily, having seen such levels before. So I think, tech will be good. And because even outside that, if we go to 2015, their valuations are in the 15, 16, 17 times. They are not in the consumer type, which is 25, 30 times. But before that, I want to take on Nikun saying that where is the next surprise coming from? You don't need a surprise. People who have had HDFC Bank or ITC or many of these don't every day look for a surprise. They just look for execution and ongoing participation in the changes happening in the market in India and the economy. And every day they're not surprising. In fact, HDFC Bank has never surprised you because it has always delivered exactly 30%. So nobody was ever surprised by its earnings, but it continues. So don't look for massive big surprises. Just regular good companies which have got half decent big picture prospects because of wherever they are in the market. And then, this thing will just continue to do well. They don't have to surprise you every day. There's nothing like that. I think these are all, because, in our industry, there are too many strategists and they have to write. So they do all these things.
Well, it's the job, Samir, to keep publishing reports, but we won't get there. Broadly, how are you aligning your portfolio? Are you aligning your portfolio with a global bent or with a local bent? Where do you think the next earning momentum, the next earning kick will come from?
Well, once again, I will repeat, we don't change our longs. We have the same 3-4 groups. In that, we change weightages. So, for example, we are mostly always in financials and private sector banks and NBFCs. We are always in consumer, and we are always in, and consumer we define broadly, so we don't have levers type, but we have consumer. And we always have tech, and that weightage has gone up in the last 4-5 months. But generally, these are the groups, and we never buy commodities, and we never buy state-owned companies. So it doesn't matter beyond a point to us, even if somebody is trading at 0.3 times book, except that if there's a massive run coming in India because of some outcome of elections, or in the short term because there was an expectation of a tapering and it doesn't happen, some of those we try and do a hit and run with futures, but not with the same heart and not with the same aggression and not with the same expected return. They work half the time, they don't work half the time, keeps everybody busy. But really the returns are made from only these 3-4 secular themes.
How are you positioned when it comes to autos, Samir? Because each of them is working with a different story, some with the rural exposure, some which have come out with price hikes in order to sort of maintain the demand, or rather tackle with the low demand right now. And then, of course, there are some like Tata Motors with the global exposure.
We normally don't like global exposure because they're very difficult to evaluate, and, very difficult to say every day what is happening in China and what's happening to BMW. But we own auto. We own the older, sort of more stabler ones, if we call auto, which is Bosch and all. But we also own Eicher, and we also own Maruti. Now, I don't know how you want to position them. That's why I don't know how to, don't give you the names and give you some descriptive features. So I'm just telling you the names because this is, once I tell you it's there, and they are not going to be sold for many months. So.
But Eicher represents the core, it has a core linkage with the economy. Maruti represents the consumer end of the economy. They are two different stocks.
Okay, so we have 40 stocks. They all different, represent different things. That's okay. We are not saying that we are in one theme or we don't like the Indian economy. Ultimately, private sector banks also reflect the Indian economy. It doesn't matter. Whatever company we like, that's what I'm saying. I didn't know how to give you a descriptive this thing. But if you want, I give you one line on each. But broadly speaking, the idea is that we are not trying to fit a theme. We are not trying to fit that we want global or we want local. But generally speaking, global are more difficult and more, up in the air kind of things. But we used to own Tata Motors also in the past. Nothing is a never in this business. Even including state-owned banks, maybe one day we'll have, who knows. But they will not be done with the same heart and with the same conviction and for the same, that means even if they go up 20 times, we will hold them like we have held a few of these things which have gone up maybe 10 times, 5 times in the last 10 years and more in the 15-20 year period. And we have never felt like selling. In some of these stocks, we will sell them for a 20% gain or a 15% gain. And in commodity stocks, if we buy once in a while, which we rarely do, we would be happy if we make 4% on a futures position. But generally, we don't like to do that because it's very difficult to predict that and to be confident about it and how much to buy even if you feel that something is going up for a small gain.
Samir, I'm glad you're giving us more than a line. Since we are not on Twitter, we have the leverage of doing that. What about pharma? What is it that you like there?
We have one or two names. Broadly, I don't like pharma. It's driven more by my analyst. My problem with pharma is that every day you have to worry about somebody getting banned either by FDI or by FDA or worried about some legal case they lose or something or the other. And then at that time, you lose 10-20% and the whole mood is spoiled. Generally, I like predictable growth and I don't think pharma is predictable growth. But because in the last 1.5 years, so many other things were not working, we bought and we made some good money last year in strides and all, but nothing much to talk about as far as I am concerned.
Samir, let's talk about private banks. Now, whereas the investment argument for HDFC Bank is still intact. They've got a great CASA, strong franchise, very strong book. But what about other banks? Axis Bank, IndusInd Bank, Yes Bank. They have a lot of exposure to infra. They don't have a strong CASA and they're still dependent on the wholesale end of the market for borrowing. Is the investment thesis for other private banks, with the exception of HDFC Bank, getting slightly diluted?
Well, we don't have all these banks, and in fact, one of these we are short. But when we say private sector banks, the menu is larger than these 4 banks. There are about 7-8 banks, and we own 4 of them. But out of these 4 that you mentioned, we own only 2, and we are short 1.
You're actually giving me one-line answers now. You're concising your answers in 141.
I don't know why, but the fund management industry has said that we cannot discuss stocks. I have, seen everything about SEBI regulations and everything. I don't think SEBI ever said don't discuss stocks. All it said was tell openly what you have and don't do a trade opposing that in the next 1 week or 1 day or 5 days or something like that you say something. But somehow the whole industry in India, because in US they even call hedge funds who discuss their shorts publicly and they present them. So I don't think even in India there's a rule. But I am being driven by my community of people who, even the strategists who are on the sell side, who write reports and send it, I think they send it to the media before they send it to the paying clients, come on TV and say, no, we are not discussing stocks. I am not sure where this rule has come from. But anyway, I am also following it because I don't know what to do better or how to do it any different.
That's what I appreciate about you. The fact that you come on forum and talk about stocks, I love this about you and our viewers always appreciate that. So give me the bent of your portfolio. How much long, how much short? In percentage, I'm sure you have that handle.
Yeah, as I said, we've been doing this for 8 years. Our average for the 8 years, we try to do it around 60, which is 90 long or 95 long and 30-35 short. And we are more or less exactly there right now.
Whom are you betting on when it comes to general elections 2014?
India is not like USA. When we talk about these things.
But in general, is the election volatility a big risk?
Actually, elections is a big positive till election results come. Because from maybe in the next 1 or 2 months, or maybe already it has started, from now to May, people will not, that is foreign investors and maybe Indian investors, will not walk away from this market without seeing this final game or final round. Because for 5 years, people have gone through bad times and good times. Last year was very good, 9 and 10 were very good, and then there's been more frustration in 11, a little bit this year. So there are both sides of what they want in life or what they want from the government. And I think that mostly everybody, because it's a fairly even betting right now in terms of which party will win. And therefore, nobody will be able to take a strong view on it. And therefore, they will not sell before. And over time, as the poll results become more, people start believing them more because they see the same momentum around them in whichever direction, then maybe there will be some calls taken. But right now, nobody will do anything on that election, on grounds of election. Therefore, it is actually holding you back from even selling, I would say.
So, Samir, what happens? I mean, we're sitting at levels of 6,000 plus. The rupee seems to be under control as of now. Trade data yesterday has been a little bit positive. When would we step out of this trading range that we've been stuck in for the last almost 1 year?
Yeah, I think that range you're not going to break away from for the next 2-3 months. And then, the thing is, first of all, this whole thing is a cycle. There is nothing that this A has done and B has not done. Okay, we can say a few things about the government, but broadly speaking, it's a cycle. So, for example, let's look at December last year or November last year, when we had the same debt ceiling issue in the US, and they said now it's been postponed by whatever period. They did not do any structural change. Last year, in the middle of last year, we were worried that Spain and Greece and all should be thrown out of the euro, and whether they are thrown out or not, they did nothing. It's just that the public moved on and said, now we're bored with those two discussions, so let's discuss emerging markets. And now they said emerging markets has a problem and they are not doing structural change. We also haven't done anything, but again, we also moved on. It's a cycle. Nobody's doing anything except on the margin. And on the margin, I have submitted and I submit that India has done more. How it has done more? Because willingly or unwillingly, its currency has depreciated. That is all that we wanted. We mean these guys wanted from Greece and Spain or whatever, that if the euro breaks, then these currencies of these countries will be able to relatively depreciate against, say, the German currency at that time, and they are not having that flexibility because they're all in one currency. That is all they wanted. So India, in some sense, by letting the currency depreciate, whether unwillingly, willingly, has made a major structural change. It is a structural change. Structural change doesn't have to come willingly because it's a change. And that change has, as you can see in yesterday's numbers, will change our exports, will change our imports, will change many things. And in addition, we did a few other things like oil price hikes. Now, fruits of that we could not enjoy because A, the currency depreciated, and B, the oil prices didn't correct. But the fact that we did so much and the fact that we are still on that path, I think is, relative to others, we have done a significant thing. Also, we opened FDI. People say FDI opening doesn't mean anything because money didn't come in. We got levers money this year for an FDI opening which may have happened 10 years ago. FDI opening doesn't mean money has to come in 1 year. It is a structural change, therefore it will happen slowly. But you did it. And its effects will not be seen now, but after 5 years. When they do something small, you say it's a tactic. You do a structural thing. When they do a structural thing, you say it is not giving any results. So India has not done great, but it's not done so badly as to what we thought it was, 3-4 months ago. And therefore, end of last month, our net was 82%. At the end of August, our net exposure was 82%. Now it is 60 because we think we have recovered that fall which was done by panic and by manipulation.
Samir, I always love your out-of-box ideas, out-of-box thoughts. Final question, something which has really puzzled me in last 1 month, which is the flow of global liquidity into Indian equities. India is not contracting, India is not expanding, GDP is contracting, earnings are not going anywhere. But the force of underlying liquidity commitment from global investors into Indian equities of late has been breathtaking. What explains this fund flow?
So if you have time, I will give you one more line which I don't like about the market participants, particularly the strategists. When they go wrong, they say this was not fundamentals, this was liquidity. This is absolute nonsense justification by a guy who goes wrong. Because liquidity comes from fundamentals. Somebody's fundamentals were poor. Therefore, he generated liquidity and it went to some other market whose relative fundamentals to that market were better. So it came from fundamentals. So if US says that I will do QE3, it is fundamental. It is fundamental because their fundamentals are very poor. Same thing with Japan. So first thing is, don't buy into any of these guys coming when they say it is bearish and it goes up. They say, no, it is because of liquidity. There's no such thing. It is because of fundamentals of somebody. But the second thing is that in India, if you see, they are currently actually not buying the 4% GDP stocks. They are all buying the IT and pharma and bit of consumer, which may be lower than their previous growth rate, not IT but others. But they're actually in some sense, so the market participants are coming in and still buying relatively the stocks which have not been affected by that GDP. So in some sense, they're not buying, we are not buying capital goods and real estate and, whatever, all these economically sensitive stocks to any significant extent. But even that trade will happen in a few months, I think. Because people, if they go beyond this, will say that at least I must have X% in the non-3-4 consensus sectors. We have also started buying one or two names. I have no guts to tell you anymore. But generally, we will all want to buy based on risk appetite, even 5%. Somebody may have 10%. But it will have a much bigger impact because those market caps of those companies are so much smaller and the sizes are so much smaller and that nobody ever buys them. That whenever all of us together will start even putting a few steps in that direction, it will make a difference to those stocks also.
Samir, very quickly, just a one-line Twitter kind of answer. From now to calendar year end, do we see a fresh high?
In rupee terms, how much are we away now? About 3-4%, right?
Yeah.
Well, that can happen.
So another 3 to 4% on the Nifty from here?
Can happen easily, I would think. Yeah.